noted at the end there just for a sense of scale that global trade is 33 trillion a year. And if just 1 trillion of that is settled in gold at the current gold price, that's 300 million ounces of gold a year. And that's roughly a tripling of annual demand for gold. So, it'll blow up the London price rigging system, and it'll cause a tremendous movement in the fiat price of gold, and it may well become unobtainable for a period of time in exchange for fiat dollars. But a fiat dollar crisis, I think, is coming as a consequence of this, and a bond market dislocation is coming as a consequence of that as well.
Monaco 64, home of alternative economics and contrarian views. Today I have a good friend on again, Jensen David, uh, at Substack, if you want to follow him, David Jensen. How are you?
I'm well, Mario. Good afternoon.
Yeah, good morning to you in Canada. And yeah, today we're speaking, it's May 7th, Wednesday, May 7th. And David, I wanted to speak to you about a couple of things. The first one is an article you wrote back in the end of March entitled "The Bank of England Gold Price Rig Now Leads to a Global Gold Shortage, sorry, and oncoming bond and currency chaos." Maybe you could go over this with us because you also talk about how the central banks have been managing the price of gold for decades.
hmm Well, I guess the underpinning for the article is the concept that the gold and silver had a not well received message to the bond markets in the 1970s. When there was very loose monetary policy run in the 60s, late 60s and 70s, and gold ran up 21 times, and silver went up 24 times in a 9-year period, and basically forced interest rates higher in the bond market. And what we see then is in 1987, with the Big Bang Financial Reform Act in the UK, that control of the world's biggest gold and silver market was given to the LBMA, pardon me, to the Bank of England, which then created this loose organization, the LBMA, to, in air quotes, oversee the trading. But what it really did was it legitimized the use of the trading of gold and silver with promissory notes, instead of actually trading vaulted silver and gold bars. And so what happened with that, Mario, was that it introduced unbelievable leverage into the markets, where they're trading now more than 200 million ounces of gold every day, and more than 3 billion ounces of silver every day in the spot market. That's for immediate delivery, and that's multiples the annual mine supply of these metals. So, what happened with the onset of using these promissory note trading system was that the gold price started to diverge from the interest rates. It had previously inversely tracked real interest rates. So as real interest rates fell, gold would shoot higher. And in that article, you can see the graphs. The first graph I think you're pointing to there is the one just with the regular CPI calculated real interest rates, and they're using the 30-year T-bond yield less the CPI. So the CPI is the rate of inflation. So if you take inflation out of the bond yield, you find out what your real yield is. And you can see there, as in the 70s, as the real yields fell, that the orange line, by the way, is the inverted price of gold. So as it plunges, gold is really shooting higher. And this graph, it gives the price of gold in adjusted 2007 dollars in constant dollars, so you can see what's going on, because there's a very confusing message that the the central banks are continually degrading and debasing the currency. So it's very difficult to get a sense of what is going on in the markets. But if you use a constant $2007 adjusted for this debasement, then you start to be able to track the price of gold and see what's really going on. And you can see with that red circle, Alan Greenspan came in August of 2007, and the LBMA was incorporated in December 2007. And these London bankers basically established under the oversight of the Bank of
Sorry, David, you mean
yeah.
1987, right?
Sorry, did I say 97? 87,
Yeah,
pardon
you
me.
said 2007, yeah, but
Oh, 2007. Okay.
it's
Wow. Okay.
1987, yeah. Yeah.
Sorry. Yeah, 87. Different time.
Yeah,
Um,
that's okay.
so in 1987, the LBMA was incorporated, and it created this voluntary rule book, which was to guide the LBMA. But it also established in that rule book the use of promissory note spot trading, which is contracts for immediate gold and silver delivery, not futures, but actual ownership contracts. And so what that allowed was, number one, trading. They could generate this tremendous trading volume and basically establish a price fixing system. But also a lot of global investment funds started, or which held gold and silver in London, were ended up holding these promissory note contracts. So they could hold gold in air quotes. They could hold gold and hold silver in the form of these promissory notes without putting any pressure on the market. And that's why you see in that graph is that after the establishment of the LBMA, you start seeing that yellow arrow pointing upwards, which is a dropping of the gold price. And it ultimately dropped in nominal terms to about $250 an ounce around the year 2000. The other thing we should note about this is that there was a very interesting discussion with Steve Forbes posted here a few weeks ago, and Larry Kudlow, and they confirmed that one of Alan Greenspan's principal indicators of inflation expectations was the price of gold. And that is what he used to set US interest rates. And we know that they fell from 20% in 1980 down to 0% here for the better part of a decade recently. So so this is the best evidence we have for the impact on the market. Now, there's a second chart below the first one, and what it uses is the constant 1980 CPI model, because they continually change the model and introduce things which reduce the acknowledged inflation rate. And what this second graph does is it uses the 1980 CPI model from the U.S. Bureau of Labor Statistics, held constant throughout the period. And when you do that with a higher inflation rate, you can see that the real inflation rate, the real bond yield drops much lower now, to about -6% in 2007 from roughly just about 2% in 2007. And so what we have had here is a continual monetary injection into the markets, and the markets have been put to sleep with this price fixing in the gold and silver markets, because these were the primary warning signals of loose monetary policy by central bankers.
Yeah, it seems to me this scheme that they had, and I learned about this thankfully from GATA back in '02 when I started looking. Well, I bought my first gold coins back in '02, and I
Yeah,
found out I was watching the markets all day, of course, like the financial markets, because I worked as a broker, and I
yeah,
noticed like some unusual patterns in the gold price. And then I looked into it. The internet was coming up, and I found GATA. But what it shows to me, David, is that they've completely, how can I say, hollowed out the middle
Yeah,
class with this scheme. It's only been the top 1% or less that have been able to protect themselves. And you say that this scheme you think is finishing, and I guess with what the price of gold is doing recently, it's really like broken out. I know the
yeah,
corrections are a bit bigger, but so you think that that's going to end and it's going to impact the bond market? I mean, it should,
yeah.
shouldn't it?
Well, yeah. So gold competed with bonds historically, and when gold and silver, for that matter, soared so radically in the 1980s from the loose monetary policy as a consequence of that, it drew funds, it drew capital out of the bond market. And by doing that, it forced yields higher because people were selling bonds and buying gold. And why wouldn't you? So, so that it set it put in place a way to radically, this is a really radical policy by these central planners to falsify market signals to allow this debt bubble to be created. And to give you a sense of the scale, for 50 years up until 1980, US total system debt, not just federal debt, but federal, state, corporate, consumer, et cetera, total debt was running about 150% of GDP. Today, total system debt is $102 trillion, and it's in round numbers about 350% of GDP. So what we have is an increase in relative debt, in debt relative to the economy of 200% higher today than it had been for 50 years up until 1980. And so what we're seeing now is that if you look at a US economy that's running at about GDP running about $28 trillion a year, there's in round numbers about $60 trillion of excess capital has been injected into the US economy. And that is what drove these asset bubbles, the continual injection of this debt-based currency, which has gone along, which happened at the same time that the debt was increasing, right? It's a debt-based currency system. So as your M2 or whatever your preferred measure of fiat money is, fiat currency, pardon me, whatever you select, it ran along with the debt because by definition, a debt-based currency, if you have to increase the currency, you have to increase the debt. But so this has now come to a head, and I think this is why you see Bessent and Trump. Part of the reason that they are doing what they're doing is that they're at a point now where they can't turn back anymore. They can't continue on this path, and they're trying to find an alternate one.
Yeah, and do you think all this tariff negotiations or tariff wars is just like a cover
Mm.
for a much bigger problem, like
Yeah,
the monetary problem? And I think the debt seems to be the Achilles heel of the whole
yeah.
thing. You noted that it went from 150 total system debt to over 300%. How much longer can that go on? And I guess that's why you think the bond markets are on life support, even though there's still a lot of people there, out there, David, who, even people who are into gold, who think bond yields are going to go
Mhm.
back to zero once there's a recession. Maybe so, but that would be mainly because the Fed would probably print trillions upon trillions, but that would destroy the currency, in my
Mhm.
opinion. And just before we came on here, I've seen from Krishan Gopal, he's an analyst at the World Gold Council. He's just noted today that the National Bank of Poland, they've added 12 tons in April to their reserves of gold,
Mhm.
and they're up to 509 tons. That's like almost double what the UK has. And
Mhm.
also the Czech National Bank, they're adding. They added 2.5 tons in April. So do you think a lot of central bankers, non-Western, let's say, they know what's coming and that's why they've been rushing for the last 3.5 years to get into gold?
Um, yeah, I think so. I think it's telling that these central bankers, with this fantastic debt-based fiat currency that they create, are rushing into gold. I mean, if their product is so great, why are you buying gold? Right? That's the fundamental question. And we hear central bankers talk about how, I mean, even David Dodge, who's the former governor of the Bank of Canada, with whom I had some personal dealings. He was a visiting scholar at UBC when I was doing my MBA there, and I got to know him a little bit. But as recently as like a year and a half, 2 years ago, he's saying that he thinks that gold shouldn't be purchased by central banks because it doesn't give a yield. I mean, this is what they've been saying for decades. And gold is up roughly 25% or 22% this year in the first 5 months alone, and you can get 4.5% on the U.S. Treasury. Which would you rather have? So I think what we're seeing now is that between federal debt that has to be rolled in the states, as along with new borrowing, it's roughly $12 trillion this year that they have to finance. And I think that Scott Bessent, he's not naive to this, not naive to the fact that how difficult this is going to be to finance. And with them being now up against the wall, they are being forced to act in a certain way. And I think when you look at the maturity distribution of these of the debt that the U.S. government holds, you'd ask yourself, why would any government do what they've done now to put roughly a third of the existing of debt coming due in 1 year, right? Why would you set up a maturity distribution like that?
I thought it was 8 trillion, so you said it's
It's
12.
a well, it's a little over nine, and then there's another two plus that they have to borrow as well,
Oh, I see. Is that
right?
after the end of the fiscal year
Well,
until?
no, there's new borrowing,
Yeah,
and then plus the debt that they have to roll. So
yeah,
it doesn't matter what number we use. These are millions of dollars when you're talking trillions, right? The
yeah,
the numbers. I had a friend who used to say that they used to reserve the number trillion for astronomy.
yeah. I know. And I guess it's akin to someone who's got loads of credit cards and they're up to here in debt.
Yeah,
Now they have to pay it off, especially at a time when you alienating a lot of foreign creditors like China and others. And talking about China, you wrote recently, and I'm gonna bring it up here right now, that you say China rapidly moves to global yuan gold trade settlement with new international gold facilities. And I've spoken about that, but just wanted to have your take on this and how important this is. And it seems to me another symptom of the rest of the world trying to protect itself from the coming collapse of this
yeah,
wonderful fiat currency system we've had.
yeah. Well, and if you look at the U.S. situation, um, what they've been doing up until now with this exporting currency and importing goods, they've been running a trade deficit of, in round numbers, $300 billion a year with China, and that is U.S. dollars placed into the hand of the Chinese. That was with it being a reserve currency, they could go anywhere in the world and buy anything they wanted with that. And to give a sense of the needs of China to continually import goods, they're importing about $250 billion a year of oil, and they're importing roughly $150 billion a year of food. So just with these two items, you're looking at $400 billion a year. And the majority of these imports would be paid with US dollars, not with yuan. And so, we're seeing articles that are really quite shocking of the impact of these tariffs. But the trade with between America and China has ground near to zero. These port facilities have come to a complete standstill. There are sailings that are heading across the ocean that are 50% full, and there's hundreds of canceled sailings now that have happened. So, when we see this impact on China, all of a sudden the tap has been very harshly turned off. There was no kind of a gradual implementation, scaling these tariffs higher to change policy. So China has really benefited from this for many decades. If you look at their economy, they export about $3.6 trillion per year. Almost all of that is manufactured goods. And when you look at the scaling factor, there's a multiplier for manufactured goods in the economy that for every dollar that you create from manufactured goods, in terms of manufactured good activity, there's another $2 that circulate in the economy on top of that. So the net benefit to the economy is 3x from manufacturing activity. And they're exporting $3.6 trillion a year, which you multiply that by three, and then a Chinese economy of about 18 trillion US dollars. About 60% of their economy is focused on manufacturing. So if they lose, they were already slowing down for the last 12 months. That was very clear. And the Chinese government has stopped publishing. More than 200 different economic indicators have been canceled now, while they're maintaining this. The growth this year will still be 2%, even though we can see a reduction in electricity consumption and slowing traffic congestion and other indicators that there's problems in the economy. But the problem that China faces is that suddenly this US dollar tap, which was currency that they could use anywhere, has been almost turned off in terms of direct trade with the US. And this $400 billion a year that they need for food and oil, plus there's many other things that they import with US dollars as well. This is putting China in a position now where they need to find an alternative currency to utilize. And I would not want to hold a Chinese Communist Party yuan. This is a political party that's killed 70 million of its people in the last century, and it's a totalitarian system, and you never know what they will do from week to week, month to month. So they need a way to have people accept this currency as a medium of exchange, and to accept it in exchange for the valuable goods which are being sent to China in terms of these raw materials. And so China's being, I don't think this is unexpected on China's part. I think this is why that they accumulated, they say 2,000 and a bit tons of gold, but I think it's likely over 20,000 tons. But now that they are in the position that they can say, well, we were forced to go onto a gold monetary unit, and this is going to have a radical impact on the rest of the world's naked fiat currencies when China does this. So back to these storage facilities, what they're doing is setting up a network of gold storage facilities at which people can exchange the Chinese yuan for physical gold purchased through the Shanghai Gold Exchange. So what it really is it's an attempted soft gold monetary unit. They're giving you the ability to source gold, but with the amount of global trade that's out there, if they start substituting this gold backed yuan, or in air quotes gold backed, but this gold accessible yuan, let me put it that way, if that starts to become a factor to any a great extent, it's going to have a huge impact on the price of gold. It's going to cause a dislocative move in the price of gold. So, and I noted at the end that just for a sense of scale, that global trade is 33 trillion a year, and if just 1 trillion of that is settled in gold at the current gold price, that's 300 million ounces of gold a year, and that's roughly a tripling of annual demand for gold. So, it'll blow up the London price rigging system, and it'll cause a tremendous movement in the fiat price of gold, and it may well become unobtainable for a period of time in exchange for fiat dollars. But a fiat dollar crisis, I think, is coming as a consequence of this, and a bond market dislocation is coming as a consequence of that as well.
How aware do you think Besant and Trump are of all this? And do you think if they are, is it probably the U.S. that has U.S. government that has been shipping loads of physical gold to the U.S. because they see the writing on the wall? And have you got any updates on the flow of physical gold to the U.S.? Has that slowed down? And maybe also touch upon silver.
Yeah,
Silver has been a bit frustrating, but there's still a silver deficit out there, production deficit, and for the last 5 years, and it doesn't seem to want to move.
yeah. Well, I think Secretary Bessent is extraordinarily aware of this. Like, I don't think that he's naive to any of what is going on. I mean, gold was his largest holding for his fund, and I think he's versed on what the issues are. In terms of you wonder how much information and how clear the information is that they're getting, but I think that this stuff is all in play in front of them, and it is a direct threat to the U.S. dollar hegemony in terms of being a reserve as a primary reserve currency. I mean, it's going to be supplanted by gold. It was always going to be supplanted by gold, but we can see it, a rough timeline now in terms of how this is happening. And I should say that I think that it's a bit of a Brer Rabbit type of situation with China. I think China has been accumulating gold with a view to supplanting the U.S. dollar, and leaving the West essentially with a burning pile of fiat, which it is, and a banking system crisis, a currency crisis, and a bond market crisis, all at the same time, while China, to some extent, is able to continue on. But they've got serious social programs and serious social problems and economic problems of their own that are manifesting themselves right now. In terms of the gold flows into the U.S., they went from about 18 million ounces in the COMEX warehouses to about 18 million to 45 million ounces of gold in about a 3-month period, and that's fallen back now to about 41 million ounces. So 4 million ounces have left the COMEX warehouses. There are other warehouses. StoneX, the large commodity house, said they estimated 2,000 tons had been imported into the U.S., which is of a different scale than the 900 tons, which have shown in the COMEX gold warehouses. So indeterminate. I was doing some reading yesterday about some analysis that was trying to determine if this was a structured plan which had been generated by the U.S. Treasury. And there's a guy named Myron, who I believe works for the Treasury. He's written a paper on a gold foreign exchange playbook for acquiring gold and pay off U.S. dollar debt with the gold ultimately. But it's basically short the dollar, long the euro, and buy gold as an intermediate asset while the euro futures mature. So I don't know if this is underway. The scale they're talking about doesn't seem to be enough in terms of current dollars. If you look at 2,000 tons, let's say round numbers, $50 million, That's about $150 billion of gold. I don't think the scale doesn't work out at current prices in terms of that being a strategy. So it's very, very difficult to say if this is treasury, if this is outside private interest. But I have to say that um, the comment that I find the most convincing is the price insensitive nature of the gold buying. It's been relentless until recently, and the gold price has started to pick up again. I don't think that we're going to see a relenting here. On the silver side, the silver warehouses increased by, I think it was about 200 million ounces in London, but they have not declined at all. We've seen that 4 million ounce decline from 45 million ounces in the gold warehouses. But the silver warehouse stockpiles increased from, in round numbers, about 300 million to 500 million ounces. And those stockpiles have not declined at all. So there was some discussion there about the arbitrage between London and New York, and that these flows were going to reverse, once the trade policy became clear in terms of the whether the bullion was going to face a tariff or not. But we haven't seen that yet, Mario. So um, it appears that it's difficult to imagine that Treasury would be buying silver either.
Yeah, I don't think they would be doing that, silver or I mean, it would surprise me definitely if they were buying silver. It would be probably a good thing. But
Mhm.
in terms of time frame, I know it's hard to know when these things will happen. So maybe you have like some signals that could tell us that we're close to this. Yeah, to the end of an era, this fiat currency era. Yeah, have you got any idea of time, or if not, what signals should we keep an eye on?
Yeah, I'm following the backwardation, price backwardation in New York. Silver is very close. It's in a minor backwardation, about flat in terms of the price of the futures versus the spot price. I think it's the relentless cadence of the gold and silver buying which tells us that this can't continue. Um, I think that I think that what Donald Trump is doing is that he is spurring chaos intentionally. And what he's going to do is force the world into major trading blocks. There'll be a US, Canada, Mexico block. There'll be an Asian block and a greater European block as the major blocks. And then South American and African nations will align as they wish. And it's going to create um, I think that these different blocks are going to try to use a naked euro and a naked US dollar to trade with, but I don't think that's going to succeed very long. I don't think China's plan to have a gold exchangeable yuan is going to work very well. I think it's going to be just give me the gold is going to be the answer after a period of time because of the decay we're going to see in China in terms of social conditions. But I think if we look really big picture here, what Trump is doing is creating these enormous trade blocks. And what that does is set up a merging of these trade blocks ultimately into a globalist, centrally controlled system. So I don't think the intention here, uh, I don't think the intention or reality is going to allow these blocks to exist independently. I think once you have this chaos theory gets released into the market, and the impact of seeing the decay of these currencies and the bonds that are printed in this currency is going to drive people more and more towards gold and silver. But I think that there's going to be at the same time a ultimate push here for global digital trade currency and a complete global system of control. Here in Canada, we've had Mark Carney over the last year gives several speeches in which he says that the Chinese yuan should, he thinks there's merit to it being the unit for settlement of international trade, which is really mind boggling when you look at the historic record of the Chinese Communist Party and how they are really the anathema to the values of the West. But I think that the values of the West are not the same as the values of the banking class. And I think China is a creation. They were given a gift for 25, 30 years of being able to import technology and import wealth from the West while exporting, with free reign goods from a system which was paying people under $10 a day with no environmental laws. Of course they would have an advantage. And of course they would, acquire a great wealth. And, a trade surplus of $1 trillion a year US on a running basis is quite a benefit to your society. It can cover up for a lot of ills in your society.
Yes, and so you think Trump, I guess he's trying to wreck this. Do you think he's also kind of the globalist agenda?
Well,
Because
knowingly or unknowingly, that's what's happening.
yeah, and
He's going to force the world into major trade blocks.
yeah, and the other thing, I guess he doesn't care. I guess if the gold price goes through the roof in dollars, because that will basically that's a default of U.S. stat, which is a good thing for the U.S., right?
If the U.S. has if the U.S. Has the gold,
Yeah.
but the issue again comes back to this mountain of debt, which has been created by the central bankers by shutting off the gold price by running a gold rigging system. Total U.S. system debt is $102 trillion as of the end of last year. And if you see interest rates going much higher, which they will, when gold runs hard, um, it's going to basically cause this reset, but a collapse of the debt market, but a collapse of the global asset bubble, which these central bankers have created. The Mark Carneys, the Alan Greenspans, the Mervyn Kings, right? These are the guys that are really have been at the core of this rigging system, which is now coming to an end.
Yeah, interesting times, David, and we're gonna keep in touch and keep watching things. And I want to thank you for your time. And yes, hopefully we'll talk again.
Okay, thank you, Mara. It's my pleasure.
You're welcome.